That's a great question to ask. We hear on these panels today and yesterday about the large amounts of capital chasing infrastructure deals. And the question is, are there enough deals to match that capital? I'd like to mention three different sectors that are emerging. One of those is energy storage or batteries. The second would be electric vehicles. And the third would be the Internet of Things, or maybe smart meters, smarter infrastructure. So just a few statistics to kind of back these things up. On energy storage, I think there's a great misconception that this sector still poses great technology risk. And while it's true that there are some 70 or so different battery chemistries being tested, the fact is that last year, at least in the US market, 96% of all batteries installed were some version of lithium ion, typically companies with great balance sheets to back those up, warranties, et cetera. The other is price. Batteries have been expensive, but the prices are falling very quickly. Estimates suggest something like 7 to 15% per year cost reduction, such that by 2020 we're talking about 30, 40, 50% lower cost than today. The other is that utilities are excited about batteries, partly for the ability to defer very large investments in transmission and distribution. And so we're seeing increasingly investors validate batteries as a new sector. We've been able recently to help source a very large portfolio of battery projects going in the western U.S. by an international bank. So I think as this develops, we'll start to see other investors coming into the space. The second, electric vehicles. This seems like a cute little niche where folks with excess capital, let's say, can have a nice hobby, a Tesla. We're huge fans of Tesla, but Tesla is not the whole market. Mercedes, BMW, Audi, Ford, many of the major global auto manufacturers are investing big in electric vehicles. Again, the fact is that they already offer a lower total cost of ownership, something like 50 to 75% lower operating expenses. And by 2022, estimates suggest that from a first cost point of view, EVs, electric vehicles, will cost the same as conventional vehicles. Groups like Bloomberg suggest that because of trends like this, by 2040, some 35% of all new sales of vehicles will be EVs, and that could the demand on the grid could amount to 10% of all of today's electricity demand, which, as you can imagine, makes utilities very excited. Just some more quick numbers. If all light-duty vehicles in the U.S. switched over to electricity, it would add a $100 billion bump to utility companies' revenues. Again, they're very excited. Part of the question is, how are all these vehicles charged? Certainly part of it will be corporate fleets at headquarters and so forth, bus depots, at homes. But I'm guessing a large portion will require third-party financing for capital avoidance and so forth when that investment is not a core part of one's business. The last area is the Internet of Things. So this is, as our friends at IBM describe it, the digitization of the physical world. So research suggests that today there's something like 10 billion connected devices, but the number is growing rapidly. Something like 40 billion connected devices projected by 2020. That's not too far away. And so areas where we can see this play out would be buying, say, operating energy assets. Think about a real estate analogy, buying a Class B property, but through better management, in part perhaps through applications of better sensors. Again, the application of the Internet of Things, converting those to be more of a Class A property. So we're working with a large provider currently in analytics and a large hydropower EPC in China to help bring the Internet of Things to the hydropower sector as one example of this emerging trend.